Welcome to Share Market Spotlight. This video is part of the NISM Series 8 Equity Derivatives module. Today's focus is on the basics of derivatives, where we will go through 30 multiple choice questions that are perfect for NISM exam practice and for improving your market knowledge. So let's get started. What is derivative? A contract whose value is derived from an underlying asset. So derivatives derive their value from other assets like stocks, gold or oil. You are not buying the asset. You are trading based on its price. So the answer is B. Which of the following is not an underlying asset in derivatives? FDs are banking products and don't trade in derivatives market. Derivatives usually involve volatile assets. So the answer is fixed deposit. Derivatives can be based on which type of assets? They can be based on metals like gold, energy like oil, or agriculture like wheat. Almost any asset can have a derivative. So the answer is all of the above. Which country experienced the tulip mania related to future trading? Holland. The first financial bubble, tulip mania, where people traded tulip future at crazy prices. So the answer is Holland. The first exchange traded future contract was introduced by which organization? The Chicago Board of Trade introduces future contracts, making trading more organized. So the answer is C. CBOT. When was the first stock index future contract launched? Stock index future were launched in 1982, starting with the S&P 500 index. So the answer is B. 1982. SEBI set up a 24-member committee under whom for derivatives regulation in India. Dr. L.C. Gupta. He chaired the committee that developed India's regulatory framework for derivatives. So the answer is B. Dr. L.C. Gupta. In which year did India start exchange traded derivatives? The NSE introduces index future in 2000, making the beginning of derivatives trading in India. So the answer is B. 2000. What was the first derivative product introduced in India? Nifty 50 index future were the first derivative product introduced in India. So the answer is index future. Which of the following is an OTC derivative, means over the counter derivatives? Forward contracts are privately negotiated and traded over the counter, not on exchanges. So the answer is forwards. A future contract is futures are regulated and traded on exchange with fixed terms and conditions. So the answer is B. A future contract is standardized and exchange traded. Which of the following derivative contracts involves periodic cash flow exchanges? Swaps involve regular exchange of cash flows such as in interest rate swaps. So the answer is swaps. Who uses derivative to reduce risk? Hedgers use derivatives to protect themselves from future price changes. So the answer is hedgers. Who uses derivatives to take advantage of price differences in different markets? Arbitrager. They exploit price gaps between markets to earn risk-free profits. So the answer is C. Who trades derivatives to gain profit from price movements? Speculators take on risk, hoping to profit from price changes. So the answer is B. Speculators. Which of the following is not a feature of the OTC market? OTC contracts are customized unlike the exchange traded derivatives. So the answer is A. Contracts are standardized. Exchange traded derivatives are standardized and regulated because they follow strict rules, are traded on platforms like NSC, BSC, and involve clearing houses. So the answer is C. Standardized and regulated. In the OTC derivatives, what is not required? OTC derivatives don't require standardization, a clearinghouse, or strong regulation. It means the answer is all of the above. How do derivatives help hedgers? They reduces risk exposure because they use derivatives to lock in prices and reduce future losses. So the answer is reduce risk exposure. Why do traders prefer derivatives? The answer is all of the above because they offers high leverage, low cost and fast execution, ideal for active traders. So the answer is all of the above. What is counterparty risk? Especially in OTC contracts, the other party may not honor the deal. So the answer is A, risk of default by the other party. What does liquidity risk mean? Low liquidity means you might not find someone to take the opposite side of your trade. So the answer is A, difficulty in finding a counterparty to trade. Which risk arises from fraud or improper documentation? The answer is operational risk, because this includes risk due to internal error, system failure, or fraud. So the answer is B, operational risk. Legal risk in derivatives refers to the answer is the contract not being enforceable, because sometimes legal loopholes or jurisdiction issues makes contracts hard to enforce. So the answer is A, the contract not being enforceable. Which document explains risks to derivatives traders? Model risk disclosure document. Every trader must receive this document outlining all major risks in derivative. So the answer is A, model risk disclosure document. Who regulates the derivatives market in India? Securities and Exchange Board of India, SEBI, oversees all trading and compliances in India. So the answer is SEBI. What is a clearing corporation's role in derivatives? It acts like a middleman, guaranteeing that both the parties meet their obligations. So the answer is B, ensures contract performance. What is the main reason behind the growth of derivatives market? The answer is all of the above, because tech advancement, global markets, and price volatility all fuel derivatives uses. What is the key benefits of exchange traded derivatives? The answer is clearinghouse guarantees settlement, because this reduces default risk, ensuring secure and smooth transactions. So the answer is C, clearinghouse guarantees settlement. So well done. We have completed the 30 questions derivatives quiz. Comment down how many did you get right, and thank you.